Are you new to option trading? Here is one of the best strategy to start your new trade. This strategy is extremely low risky one. Go through this video completely to get to know the basics of this strategy. How does it make money or lose money? When to enter, when to exit, and how to select the strike prices. And one backtesting with daily MTM graph view. How to use analysis tools before taking a new trade. Risk versus reward information. So what is this strategy? This is none other than the sell Iron Condor strategy, very popular one. So you have to sell one lot of out the money call option and you have to buy one lot of out the money call option above the strike which you sold. Similar way, you have to sell one lot of out the money put option and buy one lot of out the money put option below the strike where you sold. All strikes should be at the same expiry. As per 1st June 2020 data, margin required for Nifty is approximately 51,000 rupees to build this strategy. So how to select the strike? So I use a standard deviation calculation to select the strike. You can go to this video description to get an Excel. In that Excel, the formula and the template is available. A sample standard deviation calculation data is given in this slide now. So you can see April and May month data has been calculated here. So to calculate, you need India VIX on a particular date when you want to take an entry, and Nifty spot price data you require, and also number of days to expiry. If you have this three data, you can arrive at standard deviation, and then close by strikes you can choose to build your Iron Condor strategy. So this is a sample data. You can see more details in the Excel given in the description of this video. So how does it make money? So this strategy gives profit when Nifty stays between strike A and C. You can see strike A and C. It is nothing but A is selling the call strike and C is selling this out the money put strike. So whenever Nifty stays between this, you will be in profit together with the time decay. And whenever it crosses it, you will be in loss. When to enter? Based on my experience, I would suggest for newcomers to enter only 3 or 4 weeks before expiry. I would prefer to start it on Monday, second Monday of a month. When to exit? If the trade is in favor of you, then just 1 day before the expiry you can exit it so that you can make use of most profit. Or during your trade, whenever the loss is more than the premium received, then you have to exit. That way you can minimize your risk. So this is very important stop loss criteria. So now we look at one backtest data. You have more backtest data in the Excel which is given in the description of this video. So one of the sample data I had given it here. So for this data I had taken an entry, assumed an entry of 11th May, and with that I received a premium of 1,665 rupees. So as I said earlier, so you have to use your exit point as 1,665. Whenever your loss goes more than 1,665, you have to exit. That should be your stop loss criteria to minimize your risk. So this is the May month, May 2020 back testing data. So you can see the Nifty data. I had listed it down here. I used all the close prices of it and all the strike data is given here, and I calculated the MTM profit and loss data. So 1,665 is your premium received at the time of entry, and if you exit it 1 day before the expiry date, so you would be able to get 1,635 rupees. I will show you a graph representation. So you can see the graph here. So here in y-axis, left hand side y-axis, I used MTM profit and loss, and the x-axis has the dates, and y-axis right hand side I used Nifty data. So you can see this dark line is stating the Nifty movement, and this gray color area filled data shows your profit and loss data. So you can see with the movement of Nifty, you would be making either profit or loss. So this is to give an indication on a given day how much you will be in loss, whether are you hitting a stop loss or not. As I said, your stop loss is 1,665 rupees, which is same as the premium what you received. So in this case, you will never hit your stop loss, so you do not have to exit your position. So you can stay until until 1 day before your expiry, where you can collect your maximum premium of 1635 rupees. So let's look at the risk versus reward data. So you can see the maximum risk is the premium received if you follow the strict rule of exit point or stop loss, whatever I stated above. So with that, you would be having a risk reward ratio of 1:1, and the margin required is 51,784. This is based on 1st June margin rule. Profit and loss will be this. I assumed a commission of 200 rupees, so you will be making a net profit and loss of 1435, which turns out to be a 2.8% return per month. If you annualize it, it will turn out to be a 33%, which is really a good return with very low risk of 1665 rupees if you strictly follow the rule. Suppose if you ignore this rule of exiting at 1665, what would happen? What would be the maximum risk? That is nothing but your distance between your sell and buy. In this case, which is 300 points, you have to subtract that from the premium received, so which will turn out to be 20,835. This is your maximum risk in case if you do not follow this stop loss rule. If you want to take a new trade, you have to analyze it before taking a trade, right? So now we look at one of such sample data. So you can see here I am just taking an assumption for June month 2020. I assume a VIX of 28.68, Nifty spot as 10,142, and days to expiry is 18 days. So with that, I arrived at my first standard deviation plus and minus values, and I estimated the close by strikes, both CE and PE side. I am going to use a tool, OptionsOracle, which is a free tool to show you this analysis. You can get more details of this particular tool and how to use it. Those details are available in one of my another video. The link to that video is given in the description of this video. Now you can see OptionsOracle main window. So I already built the strategy as I showed you this standard deviation calculated strikes. So I built this Iron Condor, one short call, one long call, and one short put and one long put. I used the quantity one set, one lot, that is 75 each. So you can see the maximum profit potential is 2,141 rupees. Remember, you have to use the same as your stop loss or exit criteria. Whenever your loss goes more than 2,141, you have to exit. Otherwise, you would be hitting this. You will be in a risk of maximum loss of 20,358. And you can see here your entry date, you can put it as 8 June, and you can see the end date as 25 June. Now if you want to look at how does it look on a in each date once I take an entry, 9th June or 10th June or so on. So I can just go to this graph to have a look. So you can see the expiry date graph here, your profit and loss versus your underlying. With the cursor movement, you can see the change in stock price and profit and loss price. So what I'm going to do is I'm just going to change a date to 9th, the very next day after my entry. So this dotted curve is going to be my profit and loss curve with respect to underlying. So here you can see the break evens are changing. So here lower break even is 10,000 and upper break even is 10,000, roughly 10,600. So if Nifty crosses these 2 points, you will be in loss on this particular day. Same way you can change your date and you can check after 1 week how does it look like. So you can clearly visualize how much your profit and loss as well as your break evens. So you can go to the end date and then you can check 1 day before your expiry. So that is your 24th June. So you can see your maximum profitability will be 2,144 and your break even will be 9,400 roughly, and upper side it will be 10,900. So this is how you have to analyze before taking an entry. And one another important point is this, you can see this probability of profit, which is 83%, which is really a good. So that's why I am recommending this strategy for beginners. So I hope you all learnt a lot about this strategy. So thank you for watching this video. Don't forget to like the video and subscribe my channel.